This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Business Week podcast with Carol Massar and Tim Stenivek from Bloomberg Radio.
We continue dissecting and reading into today's monthly read on the U.S. labor market, getting our latest monthly government read this morning. We just spoke about it with Mike McKee and Mike McKenzie. The December figures cap a year where the labor market moderated from its breakneck post-pandemic recovery, Carol, without sinking into a downturn that was widely forecast earlier last year. I mean, we were sitting here a year ago and everybody was telling us this is going to be the year of a recession.
Yeah, it's really kind of interesting. So for more on what she is seeing when it comes to labor trends, we welcome Joni Biley, Chief Workforce Analyst at the U.S. industrial staffing firm Employee Bridge, on Zoom from Pompano Beach, Florida. Joni, good to have you here with us. Welcome. Tell us a little bit about, though, your firm. You know, there's lots of staffing firms out there. What particularly do you guys specialize in?
Yeah, so Employee Bridge is actually the largest industrial staffing firm. So we are supplying talent really to the supply chain. So very focused on manufacturing, logistics, really anything, though, that touches supply chain. Like we also do a tremendous amount of staffing in call centers and contact centers across the country. But many, thousands and thousands of companies use temporary labor on a daily basis, and they really turn to Employee Bridge for their workforce solutions. It provides them flexibility.
Supply demand, basically, right? If something's busy, they can just pull in workers.
Yes, and I think that's why, media and economists always look to the temporary staffing industry as a barometer, of what's really happening, because employers will turn to firms like ours, Employee Bridge, when they need to ramp up, or certainly if things are slowing down. Usually temporaries are the first to go. And that is one of the concerning things that we have seen in this December jobs report. When you look at the breakdown of the sectors, and I always tell people this, the headline number might look great, to see 216,000 jobs being created. But unfortunately, the job growth in the temporary help sector actually declined again. We saw a loss of 33,000 jobs. So that is telling us that employers are letting temporary workers go first. Of course, they're trying to hold on to their permanent workers. So that is not a great sign for the economy. That temporary worker number can usually be a leading indicator, whereas the overall job report sometimes, as we know, is a lagging indicator.
So how does what you're seeing recently compare with what we've seen over the last year or so? I mean, put it in context for me and for our viewers and listeners.
Yeah, I think, again, it comes back to the overall numbers. We're still in a very good, solid job market. But I think what we've seen in 2023 has been a lot more stabilization, maybe a bit of normalization in the overall job market. So, this year, as we look at, 2.7 million jobs added, to the economy for 2023. That's a good number, but it's significantly down from almost close to 5 million in 2022. So things are still, they're very, I wouldn't say it's robust as it was in 2022, but it's still a good job market. Unemployment's very low. Many companies are hiring. But when you break down the numbers, that job growth is really only happening in a few sectors. So you're seeing, of course, government has been very strong for the last few months. Mm-hmm. Healthcare has continued to remain strong. That's been that way for years. And I would say it's going to continue to see growth in healthcare sector jobs.
Joni, what's the biggest part of your business in terms of what area? You mentioned manufacturing, logistics, call centers. Which is the biggest that you tend to find the most activity in, generally speaking?
Yeah, definitely logistics, still is, one of the biggest areas. We also have a division, which is called Pro Drivers that does, of course, transportation and CDL drivers. There's still a very strong demand in logistics, but it is down from where it had been in 2022 and certainly 2021 when it came back so strong. So the demand is certainly still there. The energy sector.
Hey, Joni, I'm going to ask, I just want to jump in real quick because we don't have a ton of time. We just did this. It's among the most read on the terminal today. Driverless truck companies are planning to ditch human co-pilots this year in Texas. How is that on your radar, given that there are more than 1 million truck drivers here in the U.S.?
Yes, but you know what's so interesting about that is we're still waiting, of course, for a lot of infrastructure. I think where we see a tremendous amount of opportunity is you still will need drivers for once the freight actually arrives, there's still going to be a lot of driving.
So like the last mile,
driving.
kind of it's the same
the
last
mile. Yes, exactly. You're exactly right. So there is still going to be a very, very strong, strong demand. And you think about even drivers, right, with Amazon, it's hard to even imagine, life before Amazon. We're just all so used to ordering whatever we want and it shows up, right at our front door. And that really is that, last mile driver.
Joni, before we go, 30 seconds, one of the things that you guys shared in some notes with our producer is that second jobs will increase in 2024. Just quickly, why? And again, only about 30 seconds here.
Yeah, we're still seeing with inflationary costs, people are looking to make additional income. So gig work, driving, looking for part-time work. And it has been driven by inflationary costs that people are looking to work. We're seeing labor participation continue to increase. And we do think people are going to be looking for those second jobs so they can earn some more money to basically put food on the table.
Yeah.
But it's still a decent job market. And there are opportunities out there, in all sectors. But things are softening.
All right. Good, nice bottom line perspective on that. So appreciate it. Joni Biley, she's Chief Workforce Analyst, at Employ Bridge, joining us from Florida.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
I want to move when the dust runs shut. When the warm and you feel too bad. When the warm and you feel too good. I want to move drive.
All right, everybody. Among our most read stories on the Bloomberg today is one by our Bloomberg Simone Foxman and Laura Namias. It incorporates one of the biggest investment in stock stories, if you will, of 2023, the ramp up in the use of the new GLP-1 weight loss drugs. It's definitely been a boon for some drug companies. Everybody's in the pharma space seems to be searching for their own. And it seems it's also been great for many individuals tackling with obesity, diabetes, and potentially, Tim, we've talked about that this may help in many serious health conditions to help to prevent them.
So what's not to love, right? Everything's fine. All good.
Yeah, all
right?
is awesome.
Not so fast. One side effect, we could say, state and local government across the U.S. are grappling with a growing problem. These drugs are expensive and they're threatening to drain their healthcare budgets.
All right, so let's get to it. Bloomberg News reporter Simone Foxman, this is her story here in our Bloomberg Interactive Broker studio, along with North Carolina gubernatorial candidate and also North Carolina State Treasurer Dale Folwell, who oversees his state workers' health insurance. He is on Zoom from Raleigh, North Carolina. Simone, first of all, great story, so relevant. Treasurer Folwell, thank you so much for being here. You have proposed that health plans stop covering the drugs for weight loss. Talk to us about your thinking and the cost it has been to your state specifically.
I'd be glad to do that. Thank you for having me. And thanks, Simone, because what we need in this environment is more sunshine on topics like this. We are not questioning whether these drugs work. What we're questioning at the state health plan, which is the largest purchaser of healthcare and pharmaceutical benefits in North Carolina, is the cost of it. I'm holding 2 vials of the weight loss drug that Novo Nordisk distributes. In their home country of Denmark, this cost about $258. Pre-rebate, it could cost as much as $1,500 in North Carolina. We're not questioning whether it works or how it works. What we're questioning is what we're having to pay for it. If Novo Nordisk, which is a great corporate employer and taxpayer in North Carolina, if they will sell this drug to us on behalf of those that teach, protect, otherwise serve, and taxpayers like them, we could budget that. But we can't budget a cost that's 6 or 7 times higher than what they pay in their home country.
What about when it comes to Eli Lilly, which also makes these drugs? Why are you calling out Novo Nordisk here when you could also use drugs from Eli Lilly?
Well, Tim, you're exactly right. When our state health plan, when we realized mathematically that we were about to be under siege, the Eli Lilly product was not approved. So that's the direct answer to your question. Secondly, we have to watch the pennies and the paper clips, no matter if it's Eli Lilly or Novo Nordisk. And Simone's a better one to answer this than I am, but since I work at the state level, not the federal level, I'm not sure that Medicare or Medicaid even cover the cost of this drug. And it's amazing when you look at the number of prescriptions that are coming out of just the state health plan and put it in context of what $170 million worth of pharmaceuticals for about 23,000 people is going to cost the state health plan this year.
Yeah, to be clear here, what Treasurer Falwell is talking about is Zepbound, Eli Lilly's weight loss specific version of Mounjaro, which is the diabetes drug. Now, diabetes drugs, these GLP-1s are broadly approved for diabetes type 2 across various Medicaid programs as well as Medicare. The question mark becomes when you see them for weight loss. Some states, for their state health plans, for their Medicaid, say yes, this is covered, as North Carolina's had done, and some states say we just can't. We won't cover them. In part, one of the reasons is the cost. Now, Treasurer Falwell, I spoke to a lot of doctors for this story, and they were very worried about the possibility that not seeing these things covered under certain state health plans, under certain insurers, and especially under Medicaid, would create essentially a two-tier system where some people, rich people, are able to access these drugs, people with the best doctors, and others are not. What do you say to that?
Well, Simone, a great question and a great concern. At the state treasurer's office, we manage $240 billion. That's 8 times the size of the state budget. But we do not run the Medicaid program. So I can't opine about what happens because that is under the authority of the governor of North Carolina through DHHS. What I can tell you is that our responsibility at the state health plan, since we have one of the largest unfunded liabilities in the United States, $29 billion, as well as everything else is going in North Carolina. What I can tell you is that we have to do the most good for the most number of people. We have to watch the pennies and the paper clips. We have to think inside the box, outside the box. And when it comes time for the board of trustees to act, they have to figure out how to use both sides of the box. We're interested in partnering with Lilly or Novo Nordisk or anybody else in terms of trying to get the cost of this drug down. But we will not be bullied with rebates and other kinds of things that will ultimately be to the detriment of those that teach, protect, and otherwise serve, that we have a loyalty and duty of care to.
Now, some people say, some state officials, the companies themselves say that this is ultimately going to save people money over the long term. This is going to reduce medical costs. You and your consultant don't necessarily agree with that, the consultant for the plan. Why?
Well, if they would like to factor those savings at 5 basis points so that we can actually, you can't manage what you can't measure. The fact is that the cost benefit of these drugs right now is completely undeterminable. And at the end of the day, as I said earlier, we are not questioning whether they work. We're simply questioning what we're being charged for them.
It's interesting because the issue of drug costs has been around for years, right? And I feel like that is something that lawmakers, we need to figure it out, right? State of Florida is already, I think, importing drugs from Canada because to access cheaper drugs. Having said that, I want to push a little bit on this idea. I get it in terms of why isn't it cheaper, but this idea that obesity causes so many weight problems for individuals that creates excessive costs within and pressure and stress on our healthcare system. So does it not at this point make some sense in the long run?
Well, there may come a time when that occurs, but that cost benefit analysis is not occurring right now. If we continue on the path that we're on, and Simone, as you know, this is even before this becomes an oral, instead of an injection, being able to consume it orally. And what that could do to the explosiveness of the cost of this. I mean, we have a responsibility to pay the bills that are presented to us now.
Right.
And if this trend continues to go, we could have to double the individual premium on those that teach, protect, and otherwise serve based on the cost of this one drug.
Yeah, quickly, Treasurer, I want to mention, I know you're in the governor's race. You are trailing the lieutenant governor for the Republican nomination. He's been very supportive of of Trump. Are you quite as supportive, and do you think that will make you better with voters? Just quickly, we only have about 30 seconds here.
Well, Donald Trump doesn't know me or my work. He is not I'm not the Trump endorsed candidate, but I will tell you that at the end of the day, my allegiance is to the people of North Carolina to explain conservatism in a way that doesn't offend and to lower hate and to raise hope. And that's what I'm doing as a candidate for governor.
Well, we so appreciate your time, and hopefully we can continue this conversation in the future. Dale Folwell, he oversees his state workers' health insurance. He's the North Carolina State Treasurer, and as we mentioned, also a gubernatorial candidate in that state. And Simone Foxman, you rock. Great story. It's among our most read on the Bloomberg. This is Bloomberg Radio.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well-known hedge fund investor David Tepper, who went all in on 2 trades last year. One quietly helped him make about $2 billion.
Thanks, Tech Stocks.
Well done. Well done. The other has gone south in a very public way. Yeah, you probably have all seen the videos that have gone viral. Even sophisticated investors apparently can have a tough time. With more, and back with us is Bloomberg News editor Tom Maloney here in our Bloomberg Interactive Brokers studio. David Tepper, good year, bad year. Tell us about these 2 trades.
Yeah, so we started looking at this last year because we knew he had gone big into tech investments around the middle of the year at his hedge fund Appaloosa. And we calculated that those investments had made him more than $1 billion. And so we did a bit more digging around, and it turns out that Appaloosa had around a 20% return, and that was good for about a $2 billion payday for David Tepper personally. So he had a very good year at the hedge fund.
What do you do? Go home and like, honey, go buy an island? Sorry. Anyway, continue.
Well, there's lots of ways to spend that money.
Maybe buy a quarterback.
Exactly. Well
exactly.
said.
So the other big bet he made last year was on his quarterback at the Carolina Panthers, Bryce Young. They traded away their top draft pick and a few other lower down draft picks to get him, and he has not had a good year at the Panthers. The Panthers overall have had a terrible season. Won only 2 games. They've got their last game coming up now.
6 straight losing season.
Yep, 6th straight losing season for David Tepper, and his worst season by far as owner. So it's been, publicly for him, I think that's what he's best known for these days, is as their owner, and it's been, a very publicly bad season for him.
Well, I think publicly bad in the sense that a lot of people who might not even have been watching the game saw this video of him throwing a drink into the stands in Jacksonville. Mm-hmm. Let me get this straight. You started writing this story last year, and then on Sunday, this viral moment happens that he's fined $300,000 for.
For those who are watching on YouTube and Bloomberg Originals, you can see this video. It's up there.
So then this happens, and that's kind of like the perfect sort of anecdote for your story.
Yeah, it was very good timing. $300,000 really sounds like a lot. To put that in context, for somebody who's worth $500,000, that's less than $10 equivalent.
Wait.
Based on the percentage of David Tepper's net worth.
So it would be like if we did it and we got, right?
If you got it.
Did you say $10?
And like it's like $8.56 is what I
Can't even
calculated.
imagine this.
Yeah.
Okay.
Can't even buy a hot dog, right? Like I
No.
don't know for that much.
Okay, fair point.
But it's,
But yeah,
it was
it was a very public humiliation. Well, very public kind of. He was definitely in the public eye because of throwing that drink on some opposing fans last Sunday. In a moment of frustration, the Panthers were getting shut out. They lost 26-0, I think, to the Jacksonville Jaguars. So, it's been a tough year on the field for them, for sure.
what's interesting is, Tim and I talk about this a lot. Like every time there's a story or like another billionaire, buying up a sports team, like it has become, Steve Cohen and the Mets. Like there's just a lot of them. The Waltons. Like this has become kind of just the way it is, in terms of the amount of money that some of these professional teams can be worth, and billionaires have the deep pockets to do it. What is it though? What's kind of interesting is, does it speak to, all right, investing is one thing, owning a professional sports team is another one. Just because you're a good investor doesn't mean you're going to automatically be a really smart owner.
That's right. I mean, and look, to be fair to Tepper, there's obviously still time to turn things around. He wasn't, I think a lot of people thought Bryce Young was going to work out really differently than the way he has in his first season. But Appaloosa is not a big organization. There's like 23 employees according to their filing. So it's a pretty small fund. It's mostly managing his own money at this point. Whereas running a football team, that's a big organization. There's hundreds of people there and it's a complicated business.
Well, and somebody who runs a smaller firm and is used to calling the shots. Mm-hmm. You can't necessarily do that with a professional sports team. You've got to have different layers, right? And coaches and people who are overseeing different parts of that organization.
And you've got to have patience as well. And one thing that he's attracted a lot of criticism for is, he's on his sixth head coach and in 6 years. That's including interim coaches. But there's been 3 coaches fired mid-season, and it's not a good look.
That's also expensive because you end up having to pay out certain contracts if they're fired early on.
Yeah,
in their
absolutely.
deals, as you point out in the piece. The other part of this is, when you're a hedge fund manager, you're used to, and you point this out in the piece, Tom, you're used to making quick decisions and quick, big bets, risky stuff. Mm-hmm. You can't necessarily do that when you run a sports team, as Carol mentioned. Talk about the stadium, for example, and what happened with the plans for a new stadium.
Yeah, so they got some tax breaks from the South Carolina state legislature to build this new training facility and headquarters for the Panthers about 30 minutes away in Rock Hill. They started building that a few years ago. It was an $800 million facility. There was a whole lot of federal money going into it as well to build a new highway exchange. And then a couple of years into the project, some bonds that they were expecting Rock Hill to issue never came about. They pulled the plug on the whole thing. And if you look at the pictures, this was a half-built facility. I mean, it was crazy. Huge. There was, he spent close to $200 million, and then there was, I think, another $100 million in bankruptcy. So it was a real kind of fiasco. Another very public issue in his ownership. So, and that just makes it harder for him as an owner going forward.
What does he say? I mean, what does he say about all of this? I mean, he's obviously getting a lot of attention and probably negative attention because of the performance and because of some of his behavior in terms of how he responds. Because critics can, and fans, I should say, can be pretty rough.
They definitely can. And I think it's fair to say that, especially this year, that the relationship with at least the local sports media in Carolina is getting rougher.
Yeah.
He's getting a lot of criticism and he doesn't always take that well. And obviously the fans are getting frustrated as well because 6 losing seasons in a row, that's tough. All
that said, it's been a pretty good few years to own a sports franchise. Another point that you make in the piece. Mm-hmm. We've just seen values of this stuff skyrocket, even if they've had 6 losing seasons in a row.
Yeah, well, I mean, when Tepper bought the team, he was the richest owner at the time, but subsequently we've seen, the Waltons come in and pay a record amount. Josh Harris come in by the Commanders for another record amount after that, to the Broncos and the Commanders. So he's certainly made money on the investment, and it's just one of these luxury assets that there's only a limited number of, and people are paying more and more money for them every year. So I don't think financially, I don't think it's been a bad investment for him.
You wonder what's next. Like, I wonder, does he call up, Stevie Cohen and say, hey, like, how are you doing? How are you dealing? But I do wonder what's next. I mean, is there any talk or conversations? I mean, these guys like to own these teams. It's a lot of fun on some level, right? And to have it despite the losses, despite the fan pressure. But is there any talk of him unloading the team? He's made some money, right?
I think there's been some suggestions of stake sales because valuations are so high. But I also think he's an extremely competitive guy, and it would surprise me if he was to sell a team at this point. I feel like he's probably got something to prove now and is going to want to stick with it. Which kind
of definitely lines up with, there's an aspect of the story, we were talking about it before we got on air, about something he used to keep on his desk in New Jersey. I guess, was this when he first set up Appaloosa?
What was it?
I'm not going to say it.
Oh.
I don't think any of us have to say it. We call this a deep tease or a tease, but it speaks to his approach on things, right?
We can say
It's made of brass.
And it's anatomy, male anatomy.
Yeah, it's very masculine.
Masculine anatomy.
Yes.
Which makes us think he's going to kind of ride it out and see if he can right the ship. It's a great read. As we said, it's among the most read, and it's really just kind of fascinating to watch. Some of these guys who are titans of finance, right? You can figure out so much and do really well, but then when it comes to a sports team, it's a little different.
The first thing I care about is winning, he told reporters. The second thing I care about is winning. Yeah, Tom, you described him as a competitive guy. I think that's
that sums it up.
Yeah,
a great read as we get ready for the weekend. Tom Maloney, thank you so much. Happy New Year. Bloomberg News editor Tom Maloney here in our Bloomberg Interactive Broker Story. As we said, if you want to know exactly what we're talking about, just head to Bloomberg.com or check it out on the terminal. You'll find out all the details.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
A Bloomberg exclusive that this week is all about how TikTok wants to expand beyond its core revenue model, which has been advertising, right?
Yeah, of course. It's advertising. The company, our Bloomberg News team writes, aims to grow the size of its U.S. e-commerce business tenfold to as much as $17.5 billion this year. This is according to people familiar with the matter, and this would pose a bigger threat, of course, to none other than Amazon.
You know, the place where we all shop. Well, Alex Barinka is part of the team that broke the story. She's technology reporter at Bloomberg News. She joins us on Zoom from Los Angeles. A lot to get to. Let's talk about TikTok and its ambitions. Give us a little bit more color on it and how it's going to get there.
Yeah, so this will be the first full calendar year for TikTok having shop fully open in the U.S. Just before the holidays, TikTok, which folks know as a social media app and entertainment app, as you said, that mostly derives its revenue from advertising, decided, hey, let's launch a shop functionality. So now people who post videos on the app can also tag things. Brands can upload their merchandise, and you can kind of scroll through on a separate tab that looks like Amazon. They came out with this just before the holidays, and this goal for next year kind of builds off that momentum in a really big way. We've seen a lot of big tech companies in the past, think of Meta's Facebook and Instagram, YouTube Shopping, who have kind of rolled out the ability to shop. Meta's scaled those things back. So you've seen big tech kind of get involved in this space, but this to me looks like the first real competitor from somebody who comes from a social media background, who seems to be getting like real true momentum, convincing people to shop in frankly a different way than say Amazon or Temu or Shein, and shop on their social media platform.
Does it seem like it's working for YouTube? It's working for Instagram? The social, like combining the social elements with commerce. How's it working out for them?
We don't hear about it a lot, and I think that that's a pretty good indicator. We've seen Meta. Meta's a good example with Instagram. People do buy things off of social media, but most of those things are coming from ads.
Yeah.
Or those purchases are happening off the platform. What TikTok has done is basically like created this walled garden on the app where not only are you kind of seeing people talk about things, they're not linking out to other platforms, you're actually doing the whole purchase right there on TikTok. So that is a very distinct difference. There are some ads, there are just regular posts. There are influencers who get paid if people buy from their posts. But I think the real big distinction here is they are managing all of the inventory. They're matching influencers with these brands.
Okay.
They're helping the brands actually sell stuff, and that actual checkout happens right within TikTok. So, is this more, it's definitely more than what the competitors are doing. And it looks a lot more like a proper e-commerce functionality than perhaps, an ad where you click and you're directed to another website and you have to figure out how to check out over there.
You know what's interesting about this is I was talking to Carol about this a little earlier as we were prepping for this segment, and she said something like, so it's like a social version of what Amazon is doing, and I was like, Amazon has this new social tab that showed up in my Amazon app that I clicked, and it's like basically
It's I just
a
look
weird
at it.
TikTok impersonation.
Yeah.
It's like, I don't want to call it a TikTok because it's vertical video. You scroll through it, you flick it, the video up. It's really weird. I don't know, Alex, what do you make of it?
It's different.
It's different.
I
Okay.
believe it's called the Inspire tab. And we actually broke some news earlier last year that Amazon was trying to pay influencers $25 a video to post there, which in the influencer space, that's tiny amount. So Amazon seems to be mostly paying folks for those videos. As you say, the experience is just not the same. TikTok, it's a little bit copying some of what TikTok DNA is, but what they really have is kind of the magic that made them really sticky and popular on the social media side. They have this algorithm that if you're interested, Tim, in dogs and cooking content, but Carol's like me and she loves watching F1 race cars and also might have a puppy at home, our feeds will look really different. We both might see dog stuff, but we'll see things that are really catered to us. What Shop is doing is layering on to that, saying, hey, dog walking creator, here's a leash that you can tag in your post and check out right on the app. They're trying to really seamlessly integrate that discovery process of finding new things into a really entertaining format versus Amazon. If you're on the Inspire tab, I would love to hear from you. I don't hear from a lot of people who are looking there, but most of the time when you go to Amazon, you're hitting that search bar, you're typing in tube socks, and you're checking out for that one item.
The only time I go to the Inspire tab is when I accidentally click it.
He's like, whoops. I mean,
There you go.
Should Amazon be worried?
I think that this is the first kind of social media company that should actually have them worried. TikTok and its parent company ByteDance and its sister app Douyin in China have really figured out social commerce in Southeast Asia. Now, it's a little bit different over there. It's mostly focused on live shopping. According to my sources, the companies have discovered in the UK and the US, people shop here differently, mostly in your feed versus live shopping. And they're figuring that out and they're being agile. Instead of just running into kind of a roadblock saying, hey, our strategy over in Southeast Asia can't just be a copy paste here in the US. They're making big changes and hiring people with retail backgrounds. So amongst all of the efforts that we've seen out of big tech companies, this is perhaps the first one that should pose a bit of a concern. We'll see after this holiday season, what kind of brands are piling into TikTok and Shop. But certainly this would be the one that I think would raise some eyebrows up there in Amazon.
I got to say, Alex, it feels like TikTok's like out there in 2024 already. While we have you here, TikTok and Peloton, what are you hearing as you report on your beat about this partnership? Because Peloton investors are pretty excited.
It's fascinating. They are. Peloton said that they're bringing live fitness classes and other content to TikTok. And Peloton investors have driven that stock up, 14%, 15% over the last 2 days. It is part of this kind of broader strategy I talked about with TikTok. So TikTok said live stream shopping might not work here. So they split that strategy up and they said, hey, let's focus on shopping the way US users want to shop, but also let's also work on live and just getting people to tune into live content. This seems like an early example of one of these content deals that we might see from them that, it's not just an influencer, but this is a kind of verified brand that people know and have heard from, just to get users here used to and excited about tuning into the same thing at the same time, which is not really a user behavior that Americans like to do. So it's fascinating. Peloton, obviously, probably loves the young user base on TikTok. Investors are probably looking at that and excitedly rubbing their hands together. But for TikTok too, there's definitely a reason here to get people used to tuning in at a specific time and getting folks watching.
Do you
live
use
video.
TikTok a lot? Just quickly, 5
She has
seconds.
to for work.
I
You have
am.
to.
I do for work. I'm on there as well. I am also on Peloton, so I'll try it out for you guys and let you know how it goes.
Hey, it
Intriguing.
sounds good.
Are you on TikTok?
Not
Me
on
neither.
purpose. Like
Not on
people
purpose.
send me TikToks and I look at them.
Alex Barinka, have a great weekend. She is Bloomberg technology reporter joining us here.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
TikTok, everybody. We've seen this tune before as our Bill Maloney was just in our studio talking about the trade. It's like deja vu all over again because yesterday we saw a late day fade when it comes to the equity trade, and here we are
Wait,
again.
you just said we're talking to Bill Maloney, right?
Yeah, Bill Maloney.
Everybody follow Bill Maloney
Yeah.
on the Bloomberg
He's
terminal.
just kind of a cool guy,
Squawk.
knows the markets inside
This
and
guy,
out.
he knows everything. He comes in here,
Yeah.
and I can ask him anything.
I know. He's
It's
so
great.
funny. Like, right?
Yeah.
We talk about anything and everything. And he's like, yeah, well, let me tell you about this. And
He
gives
knows
us
everything.
The history. Anyway, late day fade.
Because his works are starting
Day
at 3
two.
a.m. That's why.
That's true. He's
Yeah.
out of here.
He's not out of here. He's still here. I don't know what he's doing.
I guess he has to wait till the market close. You know who's also here with us is Tony Roth, CIO at Wilmington Trust. It is time for the drive to the close as we get ready to wrap up the week, the day, first trading week of 2024. Tony is on Zoom from Philadelphia. Tony, early in the game when it comes to 2024, but it does feel like we're kind of limping along here. What's of note so far in the new year for you?
Well, thanks for Tim Carroll.
Happy New
Thanks
Year.
for having me. I think that it's interesting. It feels a lot like October, where there was a no recession trade, and I think that coming into the beginning of the year with Atlanta Fed coming in for December at 2.5% or fourth quarter, excuse me, at 2.5% now. Latest reading, having the labor market report coming hotter than expected. I think that there is concern the Fed may not hike to the degree the market is pricing in.
You mean
the stronger economic
cut? You mean
activity.
cut, right?
Cut, yeah.
Okay.
Excuse me. May not cut the to consensus given the stronger economic activity, and it's very reminiscent of what we saw in October with the no landing trade. Now, I don't subscribe to that at all. I think that we're very much headed for a soft landing, and in fact, the labor report was a terrific labor report we had today, very much consistent with a soft landing, where you see enough jobs being created to actually be disinflationary from a demand side standpoint in the economy. In other words, more jobs, more people working enables for more real consumption and for a greater pipe, if you will, or straw of supplies of goods and services. So we're right where we should be from a consumption standpoint, but we move so quickly in November and December, especially in the bond market, frankly, on rates, that anything that's going to provide a pretext for consolidation, I think is rational right now. And that's where volatility comes from in markets.
So if you're constructive and it sounds like upbeat, if soft landing is definitely your thinking and guiding thought when it comes to investing, would you be all in and buying on the pullbacks that we are seeing in this market?
Well, I would certainly be buying on larger pullbacks. What we're seeing right now are pretty insignificant pullbacks in the equity market, for sure. And when you think about what's likely to happen in 2024, there are two things that are going to drive equities one way or the other. One is going to be earnings, of course. And so we'll probably come in for 2023 in the high 220s, and consensus for 2024 is 245. That's not going to be an easy number to reach, even if we have a soft landing. And so we're going to need to see an economy that comes in probably closer to 2% for the year than 1.5%. for corporate America to be able to reach consensus forecast on earnings. But even if it doesn't, the second thing that we're going to be looking for is 5 rate cuts, not 3, or rate cuts that in total equal 125 bips. And I think that that is quite likely. And I think that even if we don't get earnings where I'm describing them, the rate environment from a Fed FUD standpoint is going to be sufficiently adaptive, if you will, to the environment and the disinflation, that we will see probably the S&P end the year somewhere above 5,000, not a lot above 5,000. So we're not talking about very profound returns, but probably 5 to 10% for the year.
So about 300 points from where we are currently. But having said that, if you think that there's going to be 5 rate cuts by the U.S. central bank, seems kind of aggressive. We've talked about, okay, if the markets really believe the Fed can do 5 or 6 rate cuts in 2024, that means it sees some problems. And you talked already about anemic growth. I feel like when we start to get to anemic growth, it's very easy for anemic growth to become a recession and a bit of a downturn. So how do you square that?
Well, I think that it's important to look at real rates, as always, right? And right now, real rates on the front end of the curve are around just under 2.5%. And on the long end of the curve, the 10-year, the real rates are close to 2% after today's activity in the nominal bond market. So we are in an environment where, as inflation continues to fall on both the headline and core basis, and our expectation is to continue to see that happen, and wage growth on an average hourly earnings basis in a monthly employment report does nothing to change our outlook on inflation. All of that suggests that in order for the Fed to keep up with falling inflation, they need to cut rates. Their failure to cut rates will, in a pace that keeps up with that inflation, will result in tightening. And so we want to see the year end with a real rate across the curve somewhere closer to 1.25%. And so with inflation falling, and given where I described real rates are now, you probably need to see around 5 cuts in order for the Fed to keep up.
So Tony, how should equity investors play this? Because if you talk about this feeling a lot like it felt in October, you're sitting kind of pretty if you had some cash then and you deployed it at the end of October, because you saw 9 weeks of gains in the S&P 500. How should equity investors play this right now?
Well, there's always, short-term volatility, drawdown. To Carol's earlier point, if we get something more than 5 or 7%, jump in with both feet, because I think that's really the story here, is that we're going to have a positive year on equities. It may not be like last year, but it'll be a positive year. In the absence of that, I think that equity investors need to be very selective. And I think the trade that we expect to see to continue to materialize is the broadening trade in the markets. So it's not just those 7 stocks, but it's a much broader set of stocks. It's quality stocks, it's financials. Later in the year, we would expect energy to start to rally once supply starts to dwindle in the marketplace as the global economy comes in stronger than expected. In pharma, we like bio, we like med tech. So there are areas in this market that are attractive. There are quality names across the market. There are those companies that are consumers of AI that are increasing productivity.
Right.
And it's a broadening trade, and it's going into small cap as well. And so
it sounds
really
like
a stock market.
It sounds like a lot you like, Tony, just in 25 seconds. So what about the Magnificent Seven, those that really were powering the market last year? Although we did have a broadening out. In just about 15, 20 seconds, would you commit new money to some of those big tech, and big cap tech names?
Only if I were underweight them. So I don't want to be underweight those names really ever, or at least I don't want to be underweight the group. There are certain names in that group that we like a lot more than other names, but as a group, those are the rails of the future of innovation and of not just our economy, but the global economy. So you don't want to be underweight them, but I also wouldn't be overweight them in this particular environment.
Got it. Hey, Tony, have a great weekend. Tony Roth, CIO over at Wilmington Trust, joining us on Zoom from Philadelphia.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.